So the next topic is the audit of retirement benefits. So we would have studied in IAS 19 employee benefits, which provides a guidance on how companies should account for their retirement benefit schemes. Like every company provides retirement benefit schemes for their employees, and there are two kinds of schemes that there are primarily as per the accounting concept. One is a defined contribution plan, another is a defined benefit. Defined contribution is where the company will decide a fixed amount that they will be contributing towards the employee's benefit, which at the end of the year, once it's accumulated, the employee will get a portion of sum which is accumulated based on how many years they are working for. But the contribution is fixed, so the amount is fixed. So this is much more easier to account and much more easier to calculate because the amount is fixed every year. It's not going to change. It's a defined contribution. But defined benefit plan is inherently more riskier, as it are set up to maintain funds for current and future payments to the former employees and their dependents. So defined benefit is where they are going to get a fixed sum of amount for even after they are retired or dead. Their dependents will get a specific, like a pension or specific amount they will get even after the employee have left the place. So that is called as a defined benefit. So defined benefit is much more riskier compared to a defined contribution. Defined benefit, we have a riskier accounting concepts as well. So again, I'm not going to go detail into this particular calculation because it's accounting is not very heavily dealt in this particular topic. So I'm going to go directly into a question, but I will give you a reading material for you to just read the defined benefit plan and defined contribution so that you can refresh your memory. Now, defined benefit plan, there are a lot of actuarial is required because actuarial valuation is required, where actuarial is a basis of statistics. So they calculate using a statistical analysis what will be the employees relative age span, what will be the time period they might live up to, and also based on that what will be the liability. All those actuarial calculation will be involved when it comes to defined benefit plan. So hence it becomes far more judgmental and riskier as well. So there are certain variables that exist in such schemes are like the fund assets. So the fund assets are the contributions they get, and definitely if you want to give some money to someone after 10 years, you will invest it somewhere, right? So that the money value can grow and you have the profits to compensate for. So there will be whatever money the company is contributing to the employee benefits will be kept in an assets and fund assets and invested in it. There will be also the liabilities which can be affected by the number and turnover of qualified employees, their life expectancy, the terms of the benefits, etc. So how many people have exited the company, how many have taken out, there will be liability as well. Like the liability is the amount the company have to pay to the employees. Fund assets are the contributions made by the employer to the plan, which are invested in a separate entity, specifically in a separate entity, which will help the amount to grow. So in future, if employee wants to settle the if the employer wants to settle the employee, they can release the fund assets and settle it from the fund assets itself, because fund assets will be money which are invested, which will grow, and liability is the amount they have to give it to the employees. Ultimately, whatever the money they have to deposit somewhere. If they don't, let's say for example, I'll tell my wife that after 10 years I'll give you 1 crore rupees. But what do? I'll say, I'll keep on telling, okay, I'll give you 1 crore, I'll give you 1 crore. I think that, okay, in 10 years somehow I will get 1 crore. What if after 10 years I don't get? She will also not get anything. So if I want to give her after 10 years 1 crore, I have to start investing today itself. So what will I do? A fixed amount of money I will keep aside and invest in a investment, shares, mutual funds, etc. I will keep investing, so that automatically I keep investing, the value of the money that I contribute will increase. So let's say 10 years time I contributed 50 to 60 lakhs, plus the assets that I have invested in, their value would have increased because the share price will increase, mutual funds, the NAV will increase, the deposits will get interest, etc. So automatically the value will also increase, which will give me some profits from the investments, and the profits together will become 1 crore. So I can easily take that 1 crore and give it to my wife. So similarly, the employer also will invest, they'll contribute, keep contributing to an investment, and that investment will grow, which will get benefit or profit, and that will grow. And using that fund asset, they will give it to the employees. In both cases, there is a risk that from one year to the next year, the changes in variables will result in the assets increase or fall in the value of assets or rise in liabilities. Both of these which could lead to an overall deficit in the fund. So there could be instances, okay, we are expecting that when we're making investments in shares, the value will increase. What if the value falls down? So tomorrow when an employee resigns, I cannot tell him, see, the amount I invested in is not under gain. Can you wait for five more years? No, he'll say, I have to get the money that I deserve. So in that case, we will have a deficit. So if there is a deficit, the employer has to contribute for the deficit, right? So those risks are also there, and hence this becomes a tricky audit to take care. So even for employee benefits, one of the things that we do as an auditor is for the actuarial calculation, we might hire an expert who will look at the actuarial calculation and give us an opinion whether the calculation of actuaries are appropriate or not, and we can depend on the expert. So one of the things that we always do when it comes to actuarial calculation is to actually employ an expert, and in such cases where the calculation as an auditor we do not have expertise on, we will hire an expert who would have done these kind of actuarial works, and they will review the work of the client and give us an opinion. All we need to ensure is the expert is competent enough, which means he have the relevant skills and knowledge. He is capable, he has enough resources, and also we need to ensure that he is independent from the client. Only then we will be able to gain comfort over his work. We should also review, just because he is giving his opinion, we should not say that, oh, you know what, he will be good only because he is an expert. We should review his work, question him, check his working papers to see how he has done the job as well. So I hope you have understood this concept. So let's try to understand it much better through an activity, which is activity number 6. You are planning the audit of Jake's Pegs, a global producer of clothes, pegs and other domestic items. The company has been in existence for 35 years and is profitable. This is the first year firm has performed the statutory audit. The audit planning was virtually complete when the finance director informed you that company operates a defined benefit pension scheme for all 750 employees for its employees. When challenged over the delay, the finance director apologized and said that the scheme had slipped over her mind. She said that she was confident that the scheme was in surplus but was still waiting for the actuarial report, which might not be available until the week before the reporting deadlines. So we need to get the actuarial report. Only by reviewing the actuarial report we will get to know the conclusion of what is the value of the fund assets and whether there is any deficit or a surplus, etc. What additional audit risk arise due to the new information regarding the pension scheme? Assuming the scheme is accounted for in accordance with IAS 19, what procedures you should expect to carry? So let us try to look at this particular answer. So what is the additional risk that the firm are facing? Is that definitely the delay. So the actuarial report which is delayed, which will increase the inherent risk of the audit, because we don't know what is actually going to come out. So when the actual report is going to delayed, we cannot do any kind of calculation or we cannot do any kind of accounting work to understand if the accounting has been done appropriately or not. This may imply the information regarding the scheme is not fully prepared yet. So if the actual report is not got, the accounting is not complete. Only after the actual report has been received, the defined benefit fund assets can be calculated and the liability can be calculated. So which means the value of the employee benefits is still pending, which means a portion of the financial statement are not yet audited. So which means that is an inherent risk. Like it is delayed means it's an inherent risk because it is delayed by the client. And as such, the actuarial report, when we get it also, it's a risky accounting. So hence it will be a bit delayed. The client has withheld this information regarding the scheme and claimed that it was an oversight. Right. So the main pension scheme is a major part of the company's financial structure, and it is unlikely that the financial director would forget about it. So you cannot say that, okay, a particular asset or a liability which is a major part of your financial statement, you cannot just simply say that, okay, you know what, it's an oversight, we forget about it. No. So the auditor should respond to this with elevated levels of professional skepticism. He might have to think from a perspective whether, what has gone wrong. There is something issue with respect to this. And he has to go with due care. Like he has to place ultimate care and also should be taken place before reliance is placed on the representations by the management. So before any data that is provided by the management, auditor should be very careful, because they are claiming that there was an oversight, but technically such issues should not would have happened. So there is something going wrong. So which means we should be a little more careful while we are pursuing for the audit. Further, the fact that the actuarial report may not be ready until late audit will increase the risk, as the auditor may be under time pressure to complete the work. So when we get the actuarial report, it will be less than very short days to complete the audit and give the opinion. So we'll be under pressure to complete the audit work and place reliance on that particular amount. The impact on the scheme on the statement of profit or loss and other comprehensive income and statement of financial position will be definitely depend upon the actuarial valuation of scheme assets and liabilities. So this particular employee benefits impacts statement of profit or loss, statement of other comprehensive income and financial position as well. So it has P&L impact, it has OCI impact, it might have financial position impact as well, like assets as well as liabilities. And all that amounts actually depend upon the actuarial report or the actuarial valuation. And this actuarial valuation is in fact judgmental and complex area, which means he may not have the expertise to audit, and for that he have to appoint an expert. So based on the actuarial report, he will send the actuarial report to his actuarial report expert, who will give him opinion on it. So if until and unless we get the actuarial report from the management side, we cannot place reliance on the expert. So hence the pension scheme would have a determinal impact on the statement of position of X. The finance director appears to be confident that the scheme is in surplus, but they may be unrealistic. So just because the finance director is confident, we cannot proceed with the audit. We have to take step by step. We need to get the evidence of actuarial report. We need to send it to our expert. The expert will evaluate the auditor's report. He might take another 1 or 2 days to review the report and give us an opinion. It is likely that the scheme assets will be held to a large extent in the form of shares and property, both of which might have fallen in value. So as I told you, the contributions to the benefit that is done by the employer will be invested in shares and assets, etc., which value could have fallen. So if the value could have fallen, the fund assets value would have gone down, which means the value could be in deficit. This may create a significant deficit on the scheme, and that could be highly material to the financial position, which could also question the going concern status of the company. So if the fund assets are lower than the liability, so whatever contribution the employer made, if the value of that asset is lower, and whatever they are supposed to give it to the employee, what they promised to give it to the employee, that value is higher, then they have to take it further money from their pocket. So let us say I said to my wife, I will give you 1 crore after 10 years. I started, investing in a SIP, and the asset value grow, but after some time it fell down. So 9th year, the value of that asset is only 30 lakhs, but I have to give 1 crore. So where will I get the money from? Extra 70 lakhs, I have to put it from my pocket. Do I have the money? No. So which means I am bankrupt. So that's the risk that we need to consider. So look at here how deeper the answer is going. This is the true example of writing an answer, and I wanted to show this to you because it's very important that how you approach the audit risk for a question or a scenario which is given in a very short manner. So the scenario here is very short. They have just given you some data relating to the plan assets and all those things, and they have also given to you and small information that the actuarial report is pending and is getting delayed. So with this, how deeper they have gone through the concept. So when there is defined benefit plan, you need to know that there is actuarial valuation, which is inherently riskier. When it is delayed, the valuation could be, impacting financial position, profit or loss, and it is time consuming. There is a lot of judgmental and complex calculation, which auditor will take time. And when it is delayed, he will be under pressure. So his deduction risk could be affected. And the actuarial valuation, we need to hire an expert to get opinion on it. And and there could be the fund assets could be, lower than the liability, which could lead to going concern issues. So all the risk are being connected from multiple areas with just one scenario or one or two sentences, and a story is created. So this is an actual example of an answer, and it's the best way you can write it. Even though you don't know the accounting rules, they are not explaining any accounting, but they are just focusing on the risk and talking about what could be the potential risk the employee benefit could incur to the auditor, is what they have explained here very nicely. And what are the procedures are performed in terms of the by the auditors for this particular employee benefit schemes. So firstly, the audit procedures performed are the finance department at JAIX would have needed to account for the scheme in line with the standards. So whether appropriate standards have been followed or not is something that we need to review. So which we can cover through specific steps that we will cover below. There are certain general procedures that we can do. We should inquire to the directors the accounting policy regarding the treatment of the actuarial gain or loss. So if there are certain actuarial gain or loss where the actuarial valuation comes in, there could be whatever they have reported in the financial statement versus actuarial valuation. The difference will be either actuarial gain or actuarial loss. So the actuarial gain or loss, you can discuss with the director what is the actuarial gain or loss, what is the accounting treatment, are you taking to P&L or OCI, what is the treatment for that. Further, the actuarial gain or loss you can also recalculate by the auditor themselves, because you get the report from the actuary and you can send it to our expert, and expert will give an opinion, so you can take that as a base. And whatever is the actuarial valuation in the last year, the difference will be your actuarial gain or loss. Very simple. Now, post that, specific audit procedures that we need to do is definitely a major procedure will be in relation to the actuarial assumptions. Like what are the assumptions taken by the actuarial with respect to this calculation of the scheme of assets. So whether the assumptions make reliable estimates of the amount of future benefits of the scheme. Will have to pay out currently in the future employee turnover, sign up dates, mortality rates, in order to have an estimate of the present value of future obligations. So what all assumptions have been used to calculate these particular employee benefits. Have they used the mortality rates, whether the present value factors have been used, what is the discount factor they have taken, what is the future salary increases, which could also increase the liability. So what is that? How much is that calculated? Employee turnover. What if the employee actually resigns? Have you considered that? What is the amount you have considered that, etc. So all these actuarial assumptions, as I told you, we can hire an expert. So as mentioned, there may be some need for an expert under the ISA 620 to review the specific assumptions and calculations made by the actuary, because it's not auditor's expertise. Auditor is not someone who does this actuarial valuation. So auditor can hire an expert. Many big four organizations will have their own expert who will be reviewing the actuarial calculations. So auditor can review the logic used and the consistency of the assumptions with the prior years and general market conditions. So sometimes if you don't get an expert, we can also use the management's expert, unless and until the management expert is an independent one. If management is using an actuary, and if that management expert is an independent, then we can also use him. So we need to just review the competence, capability and independence of the expert used by the management. Further, just because he is independent and he has capability and he has competence doesn't mean that whatever the work he has does will be proper. We also need to review the work done by the expert. So we need to review the logic and the work done by the expert to see if the consistency, compare against the prior year to see it is consistent. and review the general market conditions, whether the market have changed, whether there have been any changes to the market conditions, etc. We need to obtain written representations from the management regarding the regarding and regarding the actuarial calculation, and that they have also reviewed the actuarial calculation and they seems to be appropriate in line. And also, any assumptions that have been taken, the assumptions have to be clearly mentioned in the written representation and have to be signed by the management. Then comes the fair value of any scheme of assets. So any assets the company have invested in for the employee benefits, which are separated out from the liability, what is the fair value of those assets? That assets you can compare against the market data. Like what are the shares the employee benefits have been invested in, what are the mutual funds. You can just take the shares price of that shares directly from the market, and NAV value also you can get it from the mutual funds. For the NAV value also you can get it directly from the market. Just do a recalculation and see if the fair value makes sense. Actuarial gains or losses in the value of liabilities and any differences of the return on plan assets and the interest income calculated on the plan asset must be determined in order to agree on the amount. So this actuarial gain or losses you can actually recalculate. So as an auditor you can recalculate the actuarial gain or losses, and you can obtain confirmation from the records to see if the recalculated amount as per the auditor versus what is reported in the accounts are actually matching. Any changes that need to be made, auditor should ensure that any potential changes are appropriately accounted for. So any changes or shortfalls are adequately identified and disclosed in the financial statement. So any changes that with respect to the scheme benefits have been made, like they have increased the benefit or decreased the benefit, or they have now given out the benefit, etc. Those benefits, those changes have to be disclosed in the financial statements very clearly as well. So if you are being asked about the audit procedures with respect to employee benefits, you can write these specific procedures. It's very simple. You just need to focus on hiring an expert for the actuarial calculation. The scheme assets, you can review the market data to see if the fair value of the scheme assets are appropriate. Actuarial gain or losses you can compare against the market, and then recalculate it and compare against your records. Changes to the employee benefits have to be reported adequately in the financial statement, and disclosure also have to be appropriately made in the financial statements.